Stop buying Tesla. Seriously, at least stop buying it if you think you're investing in a car company. As of January 2026, we are witnessing the most dangerous decoupling in stock market history. While Tesla's actual vehicle deliveries dropped by 8.6% last year, officially losing the global EV crown to China's BYD, the stock price is trading as if the company just discovered a gold mine on Mars. The market is no longer pricing Tesla based on how many Model Ys it sells. It is pricing in a future where Tesla owns the world's labor through Optimus and the world's mobility through the Cybercab. But there is a massive valuation trap hidden in the timeline between now and that future. Today, we are going behind the hype of master plan. We're going to look at the real reason operating margins have collapsed to a staggering 6.2%, and why the next 6 months could be the most volatile period for TSLA shareholders since 2018. Before you click buy on that dip, you need to understand the AI trap, the BYD dethroning, and the margin collapse. Let's look at the hard numbers that Wall Street is trying to ignore for the first time ever. BYD has officially dethroned Tesla as the world's top electric vehicle seller. In 2025, the Chinese giant delivered over 2.2 million pure battery EVs Tesla. They delivered 1.64 million. That is a gap of 600,000 cars. But the volume isn't the scariest part, it's the efficiency. BYD is vertically integrated in a way that even Elon Musk should fear. They make their own batteries, their own semiconductors, and their own seats. Because of this, they can sell a high quality EV for under $20,000 and still make a profit. Tesla, meanwhile, has been forced into a brutal price war just to keep their factories running. This has sent their operating margins into a tailspin. We went from 22% margins in 2023 to a shocking 6.2% in the most recent reports. To put that in perspective, Tesla is now operating with the margins of a traditional car company like Ford or GM, but it is still being valued like a high-growth software company. At a market cap of $1.5 trillion, Tesla's price-to-earnings ratio is sitting above 300. Compare that to NVIDIA, the actual king of the AI era, which has a PE ratio of around 47. You are paying 6 times more for Tesla's earnings than you are for the company that actually builds the AI world. That is the definition of a valuation bubble. Now, the bulls will tell you the margins don't matter because the Cybercab is coming. Tesla plans to begin volume production of the Cybercab in April of this year at Giga, Texas. This vehicle, with no steering wheel and no pedals, is supposed to be the money printing machine that justifies the stock price. Musk claims the cost to produce a Cybercab will be under $30,000 and it will operate for cents on the mile. But here is the reality check. Regulatory approval is not a software update. While Tesla has over 6.9 billion miles of supervised full self-driving data, they have almost 0 miles of unsupervised public data. National Highway Traffic Safety Regulators, or NHTSA, are currently scrutinizing the steer-less design. Even if the tech is ready, the law is not. We are likely looking at a phased rollout that could take years. It starts in small geo-fenced zones in Austin or Phoenix, but it won't be a nationwide revenue stream until at least 2027 or 2028. If you are buying the stock today at $400, you are paying for 2028 profits today. And if there is even a single high-profile accident or a 6-month delay in production, that $1 trillion valuation could evaporate overnight. The final pillar of the Tesla bull case is Optimus, the humanoid robot. Musk pivoted the entire company's identity. He predicts that 80% of Tesla's long-term value will come from labor, not mobility. The goal for 2026 is to produce 50,000 to 100,000 Optimus units. To power this, Tesla is moving away from NVIDIA and onto their own silicon, the AI5 chip. This hardware is designed specifically for physical AI, the ability for a robot to walk, balance, and manipulate objects in the real world. But building a car is easy compared to building a bipedal robot that doesn't fall over. Experts in robotics point out that fine motor control, like folding laundry or tending a machine, requires sensors and haptic feedback that are still in the prototype phase. Tesla plans to use Optimus in its own factories first, which is smart. But internal use does not generate external revenue. The physical AI revolution is the most exciting story in tech, but for an investor, it's a black box. There is no timeline for when an Optimus robot will contribute even 1 cent to the bottom line of the TSLA income statement. So, where does this leave you as an investor? Tesla is currently in a transition period. The EV hype has cooled down, and the AI hype is at a fever pitch. But the gap between those two worlds is a valley of low margins and high expenses. If you're watching TSLA, you are betting that Elon Musk can pull off 3 miracles simultaneously: beating BYD on production cost, winning the regulatory war for robotaxis, and mass-producing the world's first capable humanoid robot. The biggest mistake you can make right now is ignoring the fundamentals. Tesla is a generational company, but even the best companies can be risky investments if the valuation gets too far ahead of the reality. As we move through 2026, keep your eyes on the 3 major pillars. Watch the FSD miles, monitor the BYD delivery gap, and most importantly, watch the quarterly earnings reports for any sign of margin recovery. Always remember, this content is for educational and entertainment purposes only. I am not a financial advisor, and you should always do your own deep research before making any decisions in the market. If you found this deep dive helpful, make sure to hit that subscribe button and turn on notifications. Thanks for watching, and I'll see you in the next one.